Hey, here's the thing. Sometimes the most important financial conversations, they don't really start with numbers, they start with questions. My name is Matt Landon. This is Money and Meeting. And one of the things I want to talk to you about today is questions. I think there's a series of questions you should be having and talking with your financial advisor about. And part of the reason I bring this up is because a lot of times the appointments with a financial advisor can kind of drift towards performance and then a little bit of commentary. And that can be productive. That can feel productive at least. But as you're approaching retirement, what happens is there are some really expensive problems, and there's tax considerations, there's timing, there's coordination between different professionals, meaning your CFP, your CPA, your estate attorney, and there's some assumptions that maybe haven't been challenged in a while. And in my opinion, when you sit down and you have a conversation with your financial advisor, you shouldn't just be talking about performance. Obviously, performance is important. We should address it. Hey, where am I at? Where's the market at? How are we doing comparatively to, particularly considering my risk tolerance? And has my risk tolerance changed? It's like that type of thing that is important to have. But at the same time, if all you're doing is talking about performance over the course of a meeting and maybe talking about different asset allocations, I would argue you're missing a really big piece of the problem. So one thing that I think is not addressed enough with financial advisors is around taxes. I would be having a conversation and hopefully they're bringing it up proactively. But if they're not, you should be bringing it up with your advisor and saying, how does this affect my tax return? If we're looking at this type of investment, an easy example for this would be mutual funds or non-correlated funds with after-tax money. It's like, what is this going to do for me when it comes to capital gains? What is this going to do for me with different tax forms? Is this going to kick off a K-1 or a 1099? What's going to happen here? Is this going to affect me short term, long term? Do I get a step up in cost basis if something happens to me for my kids? If there's losses, are those going to come across my regular income, or am I going to need to offset my losses with gains somewhere else? Because the thing is, a lot of times we look at it and people think about a conversation with their advisor as a math equation. Just, am I up? Am I down? In my opinion, if you're not talking about taxes and keeping that in mind, you're missing such a key piece of the puzzle, because what you make matters. What return we have matters. But at the same time, what we keep in a way is almost more important, right? Would you rather make 15% and walk away with 10? Or would you rather make 13% and keep the whole nugget? I think we'd all agree we want the 13. At the end of the day, that's more dollars in your pocket. And when it comes to taxes, I think you have to keep that in mind. The same thing comes into play when you're talking about coordinating timing of distributions. Which account do we want to pull from? We've been pulling from this account for years. Does that still make sense? Should we be updating the plan? Does it still make sense for me to be pulling from my IRA? Should I be pulling from my Roth or from my non-qualified? Should I be doing Roth conversion? Should I not? It's like, we've been doing that. Does it still make sense? So I would say there's probably a simple checklist you can run through. And this is it. 1, ask your advisor, how are they coordinating with your CPA and your attorney, and what actually gets shared before big decisions land. That's a big one. 2, ask for a clear year-by-year picture of your income, of your withdrawals, and taxes over the next handful of years, and make sure it's done in words you can repeat back and understand. And 3, ask them what could break the plan. What kind of guardrails do you have that are already in place if we have market conditions, health, or tax rule shift? It's like, what could potentially cause an issue for us, and what are we doing about it? And then 4, the last thing, and this is a big one, ask them what you should stop doing this year. If your only goal is fewer mistakes, not just more activity, right? So sometimes it's, what can we do? And that happens a lot. There's always a, what can we do? What can we add? What do we need to change? But that last one I think is really key, because it's, what should we stop doing? What should we avoid? There's a book that I read recently. It's called The Road Less Stupid. Fantastic book. And one of the big things it talks about is the best way to move forward is to not make mistakes. And an easy way to do that is to talk about it, think about it, and reflect on, what should I stop doing? So it's really not complicated. But it does require showing up with intent. I would hope your advisor is bringing this to you. This is the way I like to run my meetings. This is the way our office tends to run our meetings. But at the same time, sometimes it can take that hard reset. and you have to bring it forward. So I hope this has been helpful. Just remember, at the end of the day, the goal is not to win a meeting. It's to have confidence in your plan, in your life, and your values, and make sure that they're sitting at the center of that plan. So money is just a tool, and we want to use it to hit your goals the best way we can possibly. So that said, I hope this has been beneficial. I'm Matt Landon. This is Money and Meaning. Thanks for listening, and I hope you have a wonderful day.